Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. We had some stock splits recently. I mean, not super recently, 6 months ago. Apple split their stock 4 for 1. And Tesla split their stock 5 for 1. Stock splits are kind of rare. We're going to talk about this. I'm going to tell you a story. It's a crazy story. You know what? I'm going to skip the story. Sorry to do that to you. It's too complicated. It's too complicated. So maybe we'll do it some other time. When the stock splits happened, there was a lot of dummies out there. And the dummies are like, yes, we're getting more shares. I'm like, you dummies. So this is how a stock split works. You have 100 shares of a stock that is worth $100. So you have $10,000 worth of the stock. After the 2 for 1 stock split, you have 200 shares of stock that is worth $50. So it's still worth $10,000. There's no difference. So people are all excited. I have more shares. And I'm like, you dunce. It's the same amount of money. Same amount of money. It's an accounting fiction. Okay, there's no difference. Now, here is the interesting part. The interesting part is Apple and Tesla went up after they announced stock splits. But if it's just an accounting fiction, if you have the same dollar amount of stock, why would they go up after they announced stock splits? Now, this is the part that people don't understand. Few understand this, okay? It's about signaling, right? Now, let's say you're a company and your stock price is $100. Now, we have this concept of a trading range for a stock. Now, in the old days, this used to be about $30 to $80. If a stock was about $30 to $80, it was in a trading range. Because if you bought 100 shares of a stock, if you bought a round lot, then it would be between $3,000 and $8,000, and that's sort of a digestible amount for an individual investor. So if your stock was higher than that, then you would want to split the stock to get the price of the stock back down into the trading range. Okay. No. So why? Here's the question. If your stock price is $100, you would not split your stock if you thought the price was going to go down, right? If your stock price is $100 and you split it 2 for 1 and it goes to 50, and you thought the stock was going to keep going down, you would not have split your stock. So splitting your stock is signaling, and what a company is saying is when they split their stock is that they think the stock is going to continue to rise in the future. And if you have executives at Amazon, at Apple, by the way, Amazon is trading at $3,300 a share. And Charlie Gasparino of Fox Business, he tweeted about a month ago, he had some inside scoop that Amazon was going to split the stock, and the stock rallied. So that hasn't happened. But why would you split your stock if you thought that it was going to go down? Okay. And by the way, Amazon should really split the stock because there's a lot of evidence, they've done work on this, that a stock that has a really high price becomes difficult to trade and it becomes less liquid. And you can see this as Amazon trades. I mean, it's a $2 bid offer spread and you have 100 shares in the bid of the offer. It trades like crap. So really, Amazon should split it like 50 to 1 or 100 to 1 and get it down to that trading range. And then it's going to be a penny wide with a lot of liquidity. That's what Amazon should do. So, Warren Buffett, he's a smart guy in a lot of ways. In other ways, he's a big dummy. Because the stock is like, I don't know, $350,000 a share. He never split the stock. By the way, NASDAQ had to change their computers to help Berkshire Hathaway quote their stock because the stock price is so high. It's so dumb. If he split the stock, it would go up. It would go up because of signaling. So again, there's a lot of indications that high-priced stocks have poor liquidity. So if Amazon is $3,300 a share and you have 100 shares, split the stock 100 to 1 to $33, and now you have 10,000 shares. Yeah. By the way, Berkshire Hathaway, they never split the A shares, but they have the B shares, which are a tracking stock, which are, I think, 40 to 1 or something like that. Splitting a stock is a surefire way to get it to go up. I don't know why companies have forgotten about this. Now, there is such a thing as a reverse split. There is such a thing as a reverse split. And companies do reverse splits when their stock price gets too low. If the price of a stock gets below $1, then it gets kicked off the exchange. It gets delisted if it stays below $1 for 30 days. So a lot of companies in that situation, if it gets below $1, they'll do a reverse split. They'll do like a 1 for 30 reverse split. And the price of the stock will go up to $30 and you'll have much less shares. Okay. 1/30th as many shares. And that is also signaling. Believe it or not, that's also signaling. And what the company is signaling is that they expect their stock to keep going down in the future. So what happens when you have reverse splits, you often see the stock price go down when a reverse split is announced. So reverse splits are no fun. It is all about signaling. A stock split means that the company thinks its stock price is going to keep going up. Chipotle should split their stock. Who else should split their stock? There's a bunch of stocks that should split. But a stock split in and of itself doesn't make you any money because the market cap of the company is still the same. And this was back in the days of Portnoy, when Portnoy was pontificating on stocks and he had his green hammer and he was saying, well, you get more shares, and they keep buying the stock, which is the dumbest thing of all time. By the way, this is why the entire field of behavioral finance exists, so really smart guys can take advantage of these people. Anyway, stock splits, it's no fun if you're short the stock, and no idea if and when Amazon will split the stock. They should split the stock. Amazon should split the stock. They should split it 100 for 1 or 50 for 1. Get the stock price down to like $66. So there's a bunch of stocks out there that need to split. By the way, if you go back to the 2000s, the average stock price in the 2000s was $30. The average stock price today is $130, right? Anyway, if you own a stock and they do a split, hang on to it because it's good news and it'll probably keep going up in the future. Now, there's only been one stock I know of that split and took a dirt nap, and that's Nokia. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.